Hello again and welcome back to Investment Academy. If you are someone who is pursuing graduation or have recently graduated, this video is just for you. Today we'll discuss the most common blunders made by our young investors. If you've missed it, previously we have discussed exciting ways for young adults to invest. The link is right in the description below. Before we dive into the details, smash that like button so that the videos will reach to a broader audience, and also subscribe to our channel to get notifications while we post a new video. Let's get started. Investing is similar to putting your bucks into a piggy bank, except it earns compound interest over the amount you put in. Well, let's look into an example. Let's say you invest $200 each month for 10 years and earn 6% average yearly return. You will have $33,300 at the end of the term. Of that amount, $24,200 is the money you have contributed. Those $200 monthly contributions and $9,100 is the interest you've earned on your investment. Investing from an early age is one of the best ways to enjoy solid returns on your money due to the time factor. But we notice that our teenage investors make some mistakes in financial management, resulting in some drastic outcomes. Yet the good news is that they have the flexibility and time to recover from their expensive errors. Here are a few of them. The first and foremost mistake is putting off investment for the future. Over time, the stock market has risen steadily, averaging about 10% per year. While some years the market goes down, to capitalize on the propensity for stock prices to go up, it is the best to begin investing as early as possible. You simply could purchase index funds or ETFs each month with the savings set aside for investment purposes. Owing to the power of compounding, the earlier the money starts making more money, the wealthier the investor will be down the road. If a person starts investing at 20, they can be a millionaire at 60 with investing out half as much per annum as someone starting at 35. Second common mistake that our young investors make is to use too much leverage. Using too much leverage can backfire. As discussed earlier, our young investors possess the substantial potential to recuperate losses through the future earning era. But like highly speculative trades, leverage can ruin even a fair portfolio. If a young investor handles a 20% to 25% drop in their portfolio without being demoralized, the 40% to 50% drop that would occur at 2 times leverage might be too much to handle. The repercussions are not only loss, but also the investor might become disheartened and severely cautious in the future. However, with only a portion of the money in the portfolio, minimal leverage can be used. For instance, when a teenager acquires a $100,000 portfolio, they could start using a 2-to-1 margin leverage on 10% of the portfolio or any other percentage that works for them. Although it is risky and potential return on the trades, the overall risk on the portfolio is low. Another mistake is relying on speculative tips. Everybody has made this mistake at least once in their investing career. Have you heard your relatives or peers talking over a stock that they have heard might get bought out, have great returns, or soon release an incredible new product? In the words of Dhaval Kapadia, Director Portfolio Strategist, Morningstar Investment Advisor India, money matters are very personal, hence people tend to rely on close friends or relatives for advice regarding saving and investments. So what are our young investors supposed to do at this point? If a stock really grabs your attention, instead of simply logging into your online brokerage account to place a buy order, examine the source. Do your own homework. Try to learn as much as possible about what you are going to put your bucks into and consider the whys and what-ifs. For instance, buying a tech stock with a few proprietary technologies must be based upon whether it is the right investment for you, not solely upon someone saying that it is the next big thing. Seek a second opinion from other investors or unbiased financial advisors. Next, often our new investors fall prey to Ponzi schemes. These are combined investment schemes that promise sky-high returns in a short tenure. It pays dividends to existing investors out of capital collected from new investors instead of paying out revenues. Now, one of the most common psychologies of teenagers is to earn fast and get rich quick. So much so that they often end up investing in penny stocks and Ponzi scams like Suraja Chit Fund scam, Sahara scam, etc. FYI, in India, it is computed that these schemes managed to assemble more than Rs 66,895 crore of investments by defrauding millions of investors. You may consider putting your savings in these schemes due to greed and a desire to make quick bucks. Do not let greed take the center stage while making investment decisions. Beware and seek the red flags before you invest your money. Lastly, ad hoc investing without any plan is a typical mistake. Roger this, it is only going to harm your finances. As Yogi Berra said, if you don't know where you are going, you'll end up someplace else. Before making an investment decision, you must sit down and take an honest look at your complete financial situation, especially for teen investors who may have never had a financial plan before. If from this day onwards you want to become a successful investor, your primary step should be to draw your personal financial roadmap. Determine your objectives and risk tolerance. Ideally, seek the assistance of a financial professional. Although there is no assurance that your investment will create wealth, you will learn the facts about saving and investing, and if you may follow through with a smart strategy, you should be able to gain financial security over the years and be able to cherish the rewards of managing your wealth. William A. Ward, one of the most quoted American writers, once said, "Before you spend, earn. Before you invest, investigate." Henceforward, be vigilant, composed, and knowledgeable when you enter the financial market. Get up and get going. Start saving now, invest wisely, and retire comfortably. So that's the video, folks. Hope you've gained some knowledge. If you have any questions or suggestions, please comment them down. If you've liked the video, do motivate us by subscribing to our channel.